Hey everyone, me Kevin here. So the Fed just ended a bailout and I want to explain what the heck it means because you're going to hear this all over. You probably already have. And why are the banks selling off today? Wells Fargo, Bank of America, JP Morgan down between 2 to 4% today. Why? What's happening? And how does it affect us? How does it affect bond yields? How does it affect the market? What does it mean? Okay, so here's the skinny. Let's go back to April 1st, April Fool's Day 2020. All right, April Fool's 2020. Fed says, look, we're in the middle of a crisis. Remember the two bottoms of our market back then, right? March 23rd, April 3rd. So we were like dead in the middle of the bottoms of the market. April 1st rolls around. All right, hey, look, Fed goes to the bank and says, generally, for every $1,000 you got in assets, like loans you make, things that have to be repaid to you, investments you make, cash you have, we want you to keep an extra 3% just sitting aside somewhere in like a savings account. So as an example, for every $1,000 you have, Chase, we want you to put $30 aside in just a safe savings account. And that's the usual rule how things have been. But when this pandemic happened, the Fed said, you know what, we're going to tweak this rule a little bit. We're going to let you exclude treasuries from that calculation. Okay, so this could get a little complicated, so let's keep it as simple as possible. First, when a bank like Chase invests in treasuries, they're usually doing that just to park their cash somewhere for 6 months, 12 months, maybe 2 years, and then be able to have access to that cash, easily sell those bonds if they need to, or easily have access to the interest that comes in on those, or just, again, dump them and have that cash. This is why they call them almost cash and cash equivalents if you ever look at a balance sheet. But anyway, if the Fed comes in and says, okay, which they did, hey, we're going to exclude treasuries from this calculation. And let's say, and this is not what it is, but let's say half of all of JP Morgan Chase's assets are treasuries. That would mean that instead of for every $1,000, they have to put $30 in their savings account, they only have to put $15 aside if half are treasuries, because we're excluding those treasuries. In other words, now JP Morgan has access to another $15 per $1,000 that they can go give to people as loans, or, make loans to people with, or invest in other things, invest in businesses, or do whatever they want to do. Basically, they have more money to play with. That's the big bottom line, right? Well, the Fed said, we're going to give you that opportunity. We're going to let you do that. We'll let you enjoy this rule change for 1 year. And that deadline is March 31st. Over the past couple weeks, I have been speculating that the Federal Reserve is just going to pull the rug out from under banks and say, yeah, no, we're not extending this. You guys got enough money. We're going back to the old school way. We want 3% of all of your investment or invested assets or your loans outstanding or your treasury bonds in a savings account. In other words, we want you to have a bigger cash buffer again, which is in some sense good, right? The more cash buffers banks have, the more resilient they'll be to a crash in the future. So it's actually kind of an important step in normalizing. But banks are like, come on, man, can you just give us a few more months, or let's taper in. Let's just make it nice and easy. Well, that's been the bank's arguments. But the problem is the banks are looking at this. Look at this here. This is from Bloomberg here. The big get bigger. U.S. bank reserves at the Federal Reserve ballooned last year. And you can see here, this is a 2020 right here. And all of the cash that they have on hand actually just went straight up during the pandemic. You would think that they would have lost a lot of money and they would have lost a lot of access to capital, which would have been bad, hence why the Fed gave them that flexibility. In fact, if we go back to the April 2020 financial release that JP Morgan did, they were setting aside, and we made a video on this at the beginning of April when this was released. It's so weird thinking that this is now a year ago, but this is what I wrote a year ago, that they were basically increasing their loss expectations by 5.5 times. They were setting aside credit losses of billions of dollars. JP Morgan Chase division set aside $8.2 billion in credit losses. For the consumer division, instead of setting aside $1.2 billion in credit losses last year, Chase set aside $5.7 billion. For the corporate side, instead of setting aside $98 million, they set aside $1.4 billion for corporate losses. And even on the asset and wealth management division that you would usually set aside like in Q4 of 2019, they set aside $13 million for losses. They bumped that to $94 million in loss provisions. And this is basically just the bank saying, like, we think there's a chance we might lose a bunch of money here, so let's set that money aside just in case we do end up losing that money. So they're kind of taking this big expense. But what's happened over the last year, their cash reserves have basically just ballooned. And the banks here at the same time are like, hey, can you give us a little more time? Like, don't mind that we have a bunch more cash, but we also kind of believe that Jerome Powell reads the Wall Street Journal every day. And it doesn't help that a big cover story this week was banks eye cash reserves for profits. U.S. banks are sitting on a pile of cash that could turn into billions of dollars of profits. Bank executives aren't so worried about the economy anymore. The economy has outperformed banks' internal forecasts. Vaccine distribution is ramping up. And then Citigroup, chief financial officer, there are a lot of positive reasons to feel good about the path to recovery. It's like literally the week before the Fed makes a decision on, hey, do we want to give banks more flexibility? This runs on the front page of the Wall Street Journal about how the banks are bragging about how much cash they have, basically. Like, you think the Fed's gonna give you some leniency? No. So we saw this coming, right? We saw this coming. I talked about this last week about I don't think this is gonna get extended. The Fed's gonna pull the rug out from under them. Okay, so now you got the background. You got the detail on the rule, which that part doesn't matter so much. You got that the banks set aside a ton of money for losses, but a lot of those losses didn't materialize. A lot of those billions of dollars they were setting aside for just in case losses, now, as you saw from that Wall Street Journal article, they're like, well, we didn't lose that money, or a lot of it. We didn't lose as much as we thought. Let's just turn that back into profits, because they wrote it off last year, and now they're going to consider it an earnings again. It's like income again. So record profits, right? Again, Wall Street Journal article. So what does this actually mean for the market going forward? Now that you're caught up to speed with what the heck is going on, what does this mean for the market going forward? Well, it kind of doesn't mean much. See, a lot of people are like, wait a minute, if banks have less money, that means they're less able to buy treasuries, and that would be bad, right? Because if banks are less able to buy treasuries, then that means there are less buyers of treasuries, which basically means the yields of treasuries could go up as the price of treasuries goes down because there are less buyers. That gets tricky. But people make this argument, and there have been some, reporters and news articles going, oh my gosh, this could be bad. This could force yields up. The Fed pulling out the rug from under banks here. I don't think so. The reason I don't think so is banks do not actually make up as much of a buyer of treasuries as we think. In fact, the biggest buyer of U.S. treasuries are actually private individuals. Right here, federal debt held by private investors. The bank line, like the U.S. bank line, is actually this blue line over here. It's the lowest out of the three. So we have more foreign and international investors buying our treasury bonds than we have U.S. banks buying our treasury bonds. And of course, we have way more U.S. investors buying our bonds than international or banks. So they make up a small percentage of the buyers for bonds. Who cares if they buy a little less? It's not that big of a deal. My opinion going forward is we're going to see bond yields go up. It's gonna happen. Whether or not the Fed was pulling the rug out from under banks or not, I don't think makes a difference. I think we're going to see this 10-year go to between 2 and 2.25%, and we're gonna sit there. And between now and the day that happens, we're gonna end up feeling a little bit of a burn at some point. That is, somebody's gonna come up, one day these bond yields, this is the 10-year chart right here, one day this is gonna go from 1.73 up to like 2, or maybe it'll go 1.9, then it'll go to 1.95, then 2, then 2.1, and it'll sit there. I don't think we're going to go above 2.5. We're not going to go to these crazy levels. When we went to crazy levels, which the 10-year was like 2.5 to 3, was when the Fed was actively raising rates, which we're not actually expecting the Fed to actively raise rates until we get to around 2023. So that's why I think we'll settle around 2 to 2.25 on the 10-year. The 5-year will go up as well. It'll go back to kind of those 2018, 2019 levels that we've seen, more like the end of 2019, beginning of 2019. But anyway, the point here is to say that there is going to be a bandage pull-off. There's going to be a little ouchy moment where these rates adjust up a few more times, and that's going to lead to pain in the stock market. I don't think it's going to be because of this Fed change here. Even though this is headline news about the Fed changing, basically pulling the rug out from under banks, it's not that big of a deal. The banks saw this coming. The banks were asking for an extension, but I can almost, look, if I could make the expectation, or if I could come up with the expectation that the Fed's not going to give you this extension, especially after we get articles like this and quotes like this on the Wall Street Journal, the bank CEOs are like, they're not going to give us the extension. Like, nobody is really surprised by this. For some reason, the stock market is a little surprised by this, and you've got JP Morgan and Wells Fargo down already. If I owned those, I would have sold before this because we knew this would come. But I think it's temporary anyway. 2.5% decline on the banks. Nobody freaking cares. The market's already recovering anyway. So we got the news over here. You saw the sell-off. The banks went down like 4%. Big deal. They're already recovering. They're still down 2-3%, but we're already recovering in the day. Short term, this is not a big deal. This is quadruple witching day, and as expected, the market's doing fine. It's rebounding off the bottoms that we had yesterday. No big freaking deal here. But stay tuned. Even though this happened with the Fed and the banks, and even though that doesn't matter, what are you watchful of? This is the big bottom line I always want you to take away, especially in this environment that we're in. Yes, partially, don't squander the dips, right? Don't squander red days. Like, I bought the red early this morning. I'm really happy I did because what I bought is already up very nicely. Now, as far as going forward, though, even though part of us doesn't want to squander the dips, don't squander a good red day, we got to be vigilant going forward because we are going to expect that volatility. It's not going to come from stupid announcements like this. It's going to come from those bond yields actually moving. Today, that's not going to make a difference. It's going to come from those inflation expectations and those fears. And we know those fears are going to accelerate over the next 3 months, or at least we strongly believe that they will. And so I am expecting a lot more volatility over this next 3 months. This news doesn't matter. The inflation play, still something to be concerned about. We're going to see that hyperinflation. You know my opinion on this. Anyway, and just to recap, I don't think so. But anyway, thank you so much for watching this, so you have sort of a breakdown as to what's going on, what this news actually means. If you found this helpful, consider subscribing. Check out that coupon code down below that will expire soon here as the final stimulus checks come in. And folks, we'll see you next time.